hope you're doing well. This is Drew Creekmer here with Andrew, who's one of our wealth advisors in our Central Illinois office. And in today's flash briefing, we are going to myth bust or talk about a rule of thumb that is big in the financial planning and investing world. And that's the concept of buy low, sell high. The reality doesn't really match up with the mindset of buy low and sell high. But before we dive into that, I hope you had the chance to attend our Truth Live event in East Peoria or caught it online. In that event, our senior wealth advisor, John Creekmer, and an economist, Andrew Updike, dove into all the major events going on in the world that's affecting the economy and markets at large. That said, if you were not able to attend, shoot us an email and say, hey, send me the recording or the link to the YouTube video so I can watch that. It'll be very well worth the 20 or 30 minutes of your time it takes to watch that video to kind of get a bare bones take on what exactly is happening in the world at large. And so that said, let's dive into it. Andrew, how you doing today, man?
I'm doing well, Drew, and yourself?
I'm doing well. It's sunny and 75. I'm wearing shorts, even though you can't see it. So I can't be doing much worse.
Yeah, I think it's about 45 degrees here, and it rained all day yesterday, so I don't feel too bad for you.
Oh, I'm sorry. I'm sorry to rub it in. Oh man, I'll be heading that way here soon enough, though. So, well, cool. Hey, let's dive into it and talk about this concept. We've all heard the phrase "buy low, sell high," and it's one of those cardinal truths of investing. But me and you have been in this business long enough that we've seen that the reality generally looks much different than that. So can you kind of walk us through some of the issues or examples that you've seen of people not really following that cardinal truth?
Yeah, so I guess when you say, buy low, sell high, that's a kind of a subjective thing because, how do you know where the low is and how do you know where the high is? So, you can never really predict that. So, sure, you can buy low and you can sell high and you can make a profit, but was it worth your time to actually sell it at that point, because it could keep going higher and higher? Or versus on the flip side, if it's going down and you decide to sell, when's the rebound or when's the bottom? I think that's the hardest thing to pinpoint, and it's really impossible to do. Is if you can look at the hedge funds of the world and the active managers and all the studies out there, and I think I've written an article about them. It's the numbers just don't add up for the percentage of people who can actually do that on a consistent basis. So it's just a hard thing to do.
Yeah. And so it's one of those things where, you mentioned it's almost impossible to really time the market. And there's so many inputs or factors going on. And then on top of all the data or all the noise and news you have on CNBC and the like, you also just have the emotional aspect of it. We sometimes show a chart of the market cycle of emojis or emotions. And I think one of the hardest things to do in investing is to manage your emotions. And that's why we always try to tie an investment back to a goal to help remove that emotional aspect of it. What are some things that you think is really important on managing the behavioral side of investing, just based on your experience?
Yeah, so at TD Ameritrade, and when I spent about 4.5, 5 years there, I think a lot of the traders who come in and, they're probably not planning on trading and they decide to make a trade. And it's actually, I was reading about it a few weeks ago. It's called availability heuristic. And it's basically overestimating the probability to profit on a trade due to your one time success or, my brother in law made 20 grand off of X, Y, and Z. So I think, and unfortunately, one of the worst things that can happen to you is, you hit really big on the first trade you ever do. You 100% double your money, because then you kind of think you're unstoppable at that point. And there's a good chance you're not going to continue to do that. So that just plays into the psychology of, hey, your past trades are not going to be, you can't do that every time. And if you could do it every time, you might be one of the smartest people in the world.
Right, right. And hey, let's put this chart up here. I think this is a great chart, showing just the probability of returns, over a certain time period. And you just hit on it. You may get lucky every now and then on a trade that you do one day versus the next. You may hit on that. Statistically, most people see a positive return about 50%, 6% of the time. On those positive returns. But that's where the pros are playing. That's where the experts are playing. And you already talked about how even the best hedge funds in the world, they don't get it right 100% of the time. I think some of the most successful hedge funds ever, if they have a win rate of 60% of their trades they make money on, that's incredible. And so the reality is, as a consumer who's investing, trying to invest or day trade is really probably going to be a losing proposition in the environment we live in. And so that's where expanding your time zone, investing for the long term, is really the best way to determine success in investing. Remove that mindset of, hey, I'm going to try to time the market. I'm going to try to buy at the perfect spot. I'm going to try to sell it. Generally, you're going to lose trying to do that and lose money. And so, Andrew, when you're talking to your clients, how do you walk them through the conversation around investing and timing with this in mind? Do you say, hey, we're playing the long game, it doesn't matter what's happening in the economy and the world, or hey, we need to take that into account and maybe shift things from time to time?
Yeah, so it really comes out to, you know, time in the market versus timing the market. And you'll probably agree with this. And, if a client's not for that game plan, they may not be the best fit to work with an advisor or anything of that nature. Any planning, they can, do their own thing. But for those who want to stick to a plan and understand the long-term effects of the plan, that's kind of what we're going for. So I think just kind of developing a plan and then making adjustments as needed depending on market conditions, geopolitical issues, inflation, anything like that. But to go in and out of it is just not something that we do.
Sure. And you mentioned time in the market versus timing the market. And let's talk about this chart here. That's such an incredible piece that really shows what happens if you miss, the best 10 days or the best 30 days in the market return. What happens to your net return over, a 20-year time period? I think this is a fascinating chart. Kind of walk us through this, Andrew, what we're seeing here on the screen.
So basically what we have here is it's showing the S&P 500 index from 2001 to 2020. So what this is showing is if the first, bar is saying, hey, if you spend this time period in the market and you don't buy, you don't sell, you kind of just ride the waves, the ups and downs, it looks like the return is going to be 7.5%, which is a very good return over that time period. So if you decide to go in and out and you miss the top 10 days, you go down to about 3.4%. So that's, you lose half of your return by just missing 10 days. And you got to think of how many trading days are in this almost 20-year period. If you miss the 20 best days, your return goes from 7.5% to 0.1. So essentially, just these 20 days could make or break a plan in general and could cost an investor a lot of money. And it goes on to say 30 days, you're in a negative return then as well.
Right. So it's where having that long term mindset, it's so hard because think about all the crazy things that happened in that 20-year time period. We had the dot-com bubble had just burst in 2001. We had the Great Recession in 08, 09. We had a number of other just small black swan events that kind of popped up. Staying invested is a lot easier said than done. I think it's a lot easier said than done than maybe buy low, sell high. I think the reality is fighting your emotions is ultimately the biggest determinant of long-term investing success. And so, Andrew, when we think about what we've talked here, what would you encourage people to do to help them be placed in the best position for success as investors and just from a financial planning standpoint?
So number one would be talking with a financial planning firm, a wealth advisor, anyone of that nature, and getting a plan set in stone. Because if you're trying to do it yourself, you may not have the knowledge, the experience, or even the desire to want to sit there and do that. So that's kind of what you hire someone for. So getting a plan together and, sticking to that plan. And that's where, financial advisors such as yourself and I come into effect. Because how many times during the market downturn did you have clients call in and say, hey, Drew, I think we should sell, or, and we obviously know by numbers that's not the best choice. And sure, I do feel that way emotionally sometimes too, but I've read hundreds of studies that say the complete opposite. So you just got to, walk them through that, and hopefully they're willing to stick to the plan and not go rogue.
Right, right. And that's where, I like to kind of refer to as, we're the shield against you as our client making maybe an emotional or harmful decision. We're going to provide you the facts. That's what you pay us for. Like Andrew just said, we're going to say, hey, here's where we're at, here's what's going on, and here's the facts about the long term. We're going to try to help you focus in on really the exact decision that's going to help you make the best decision to have long term success. And so having that emotional shield is so important. And Andrew, I think the other thing is a lot of people maybe haven't evaluated the risk that's associated with the time frame for their goal. And that's why each client that we work with, we always try to narrow in first and foremost, what is the goal that you're planning for investing for? If it's for, hey, I want to stop working in 30 years, well, your risk for that goal is pretty high because your time frame is so long. And so with that in mind, you can ride the waves of the market and not worry about it, because over that 30-year time period, there's going to be great years and bad years. But as long as you stay invested and you have a good investment plan, you're going to be fine. But if you're someone who's maybe in that yellow zone, that 1 to 3 years from stopping working or maybe making a big purchase like a home or a new car, your risk tolerance might be much smaller. And so that's where having an advisor like Andrew or myself or anyone on our team help you determine what is the appropriate risk in investment selection is so critically important for your investing success. And so, Andrew, for those of people who maybe haven't analyzed what their risk tolerance is for their goals, what would you tell them to do?
Go talk to, myself or you or any financial professional that can analyze that and put it down on paper for you. Because I think that's one of the biggest things that people don't understand is what their risk is. People say, oh, I'm a very conservative person. And well, if you're 30 years old and you're going to retire in 30 years, the last thing you should probably be is conservative to some extent. You should be taking a little bit of risk due to your time frame versus, and you've seen it as well, clients who are 1 year away from retirement and they're at Caterpillar and they have all their dollars in Caterpillar stock. Well, that's probably a little bit more risk than they need to be taking. So, I think the idea in your head of what your risk is and where you actually are is totally two different things. And I think a third party needs to be able to tell you that and put it down on paper.
Sure. Sure, absolutely. I think that you nailed it around the head. So, if you are someone who's saying, "Hey, you know what? Maybe I tried to time the market in the past, or I have a major life event or purchase coming up, and I want to make sure I have the right risk in my investments," we would encourage you to reach out, shoot us an email, give us a call. We'd love to talk with you about making sure that you have the right risk in your investments. Or on the other hand, if you say, hey, I think I'm good, but I'd love to hear from Andrew Updike and John about just what's going on in the world at large, let us know. We'll send you the link to the YouTube where we have that video posted. It's a great recording. We would strongly encourage you to check that out as well. So that's what we have today. Guys, if you found this, hopefully you found this helpful, and we look forward to talking to you soon.
Have a good day.